everyone, and welcome to the Master Series, your guide to intelligent production, brought to you by Entertainment Partners. I'm your host, Natalie Nelson. In the Master Series, we focus on important issues impacting the entertainment industry and its workers through in-depth discussions with our legal, tax, payroll, technology, and production experts. And today, our experts will be discussing important legislative changes going into effect in the UK that will impact production budgets in 2025. This is your chance to hear from them and ensure that you are prepared for the year ahead. Two quick housekeeping items as we get started. First, we encourage you to join the conversation by posting your questions in the Q&A section of the Zoom call. You can do so by clicking the Q&A icon in the navigation menu. We will save some time after the discussion today to answer questions, so please share your questions if you have them. Also, please take a few moments after today's webinar to answer a short feedback survey. This is an opportunity for you to give us feedback as well as to suggest topics for future webinars. Your feedback is very important to us, and we thank you for it. For nearly 50 years, Entertainment Partners has been at the forefront of the industry, continually investing to ensure our clients and their productions are successful no matter where they are headed. Our established and growing teams in North America, the UK, and Australia specialize in payroll, technology, incentives, tax, and accounting services. And our UK experts, who you will hear from today, offer decades of experience and the best guidance in the industry. Now I'm pleased to introduce you to today's panelists. Lloyd Gunton is joining us as our Director of the Creative Sector Tax Incentives in the UK. He has over 13 years of experience in accounting practice, including his training time at Ernst & Young in their media audit division before moving to Safry Champness to specialize in the creative sector tax credits. He has worked on productions ranging from micro-budget independent films to some of the biggest Hollywood blockbusters, as well as high-end television shows. His credits include No Time to Die, His Dark Materials, The Wheel of Time, 1917, and the recent remake of Bergerac, which premieres next week. He joined Entertainment Partners in April of 2023 and heads up the UK Creative Sector Tax Incentives offering for us. Also joining us today is Kristy Carty, our Vice President of Payroll in the UK. Kristy brings 25 years of UK payroll experience to Entertainment Partners with a unique blend of technical expertise and strategic insight. She has worked across various high-profile sectors, including global payroll software and financial services, before moving into the film industry. As VP of Payroll, closely with our clients and understands the need for flexibility while providing an accurate and compliant payroll service, meeting the unique complexities of the film industry. She has worked on productions ranging from small independent films to large studio productions and high-budget television shows. Her recent credits include Sex Education, A Gentleman in Moscow, Gangs of London, and the BAFTA-winning and Oscar-nominated films such as Conclave. She joined Entertainment Partners in 2022 as our Vice President of Payroll and leads the strategy and development of our UK payroll offerings. Also with us today is Katie Weeks, Senior Vice President and Managing Director of Global Casting. Katie oversees the global strategic development and growth of the casting portal to meet the demands of feature film and high-end television productions worldwide. An expert in background casting processes, digital transformation, and strategy, Katie works closely with leading casting agencies and productions across the globe to revolutionize their working processes through seamless adoption of EP technology. Before joining Entertainment Partners, she held numerous commercial positions at leading UK arts and media organizations, including Condé Nast and the London Calling Arts. In 2022, she joined Chief, a leadership network for women in executive roles. And finally, our moderator today is Bogert-Upton, Senior Vice President of Sales and Account Management here at Entertainment Partners on the stateside. Caitlin's 20-year career in the entertainment industry began with EP's Central Casting, where she worked on hundreds of shows, including CBS, CSI Miami, and the Michael Bay film The Island. Following that, she spent years becoming a product expert and leading EP's product sales team, responsible for Global Vista, Vista 5, VPO, Movie Magic Budgeting, and Movie Magic Scheduling, eventually becoming the product manager for the Movie Magic Suite and other products. Leveraging her deep application knowledge, she moved into payroll sales, working with independents, production companies, and major studios, helping to drive adoption of smart accounting. Today, she leads the global sales and account management teams here at Entertainment Partners, servicing all clients in all territories. Caitlin and panelists, thank you so much for joining us today. It's wonderful to see you.
Thanks, Natalie.
Absolutely.
Well, thanks everybody for joining us today. We're very excited to discuss this topic. We've got a bunch of experts here. I'm lucky enough to just get to kind of guide the conversation. So thank you to the panelists for joining us, and thank you to all of our participants. This particular master series was born out of some conversations we were having with some of our studio clients at the end of 2024. Just with clients really, being interested in the UK. Obviously, Lloyd's going to talk to us a little bit about, what's happening in the territory, why productions are going there. And we thought it might be a good opportunity because it's the beginning of the year to really just kind of dust off the basics and have some kind of general conversations around what's unique in going to the UK and really just trying to kind of set the foundation for you guys. So I think, that's really our goal today, is just to kind of make sure that everyone's aware of some of the nuance and that, again, kind of dusting off some of the basics to make sure you guys have what you need to be successful when thinking about going into the UK territory. So I think with that, Lloyd, if I can, I know that the UK continues to be a top location, attracting lots of productions from North America specifically and internationally. Maybe you can kind of help walk us through just some of the highlights as it relates to the UK in 2025.
Yeah, absolutely. I mean, the first thing to sort of cover is we're now well into our new incentive regime, which is the audiovisual expenditure credit, which is AVEC. We've got a diagram up on screen that just shows the different strands of AVEC and how they work together and the sort of the values of them. I'll run through it quickly because I know it's not the main focus here, but down the left-hand side, we've got the independent film tax credit, which is the brand new one. You can apply for it from the 1st of April this year. Up to 15 million qualifying spend on a 23.5 million budget gets you a rate of 39.75%, which capped at our 80% limit is 31.8% potentially of your budget. So it's a really high value relief, that one. For animated films, it's 29.25% with the cap therefore at 23.4%. And for all other films, it's 25.5% capped at 20.4%. All of these are slightly higher than they were under our old regime as well. So there's only good news really in terms of the value coming in from AVEC. TV side, children's TV and animation, they got that increased rate of 29.25% to 23.4% capped rate. And high-end TV, so over £1 million an hour of spend, is at that 25.5% and 24.4%. So we've got a new suite of regimes come in, all of which are higher than they've been before. We've got the independent film tax credit come in, which has had a huge impact, really. And as well as that, for the two right-hand light blue columns there, from the 1st of April, VFX spend can be uplifted to 29.25%, UK VFX spend, that is. And that's uncapped, so it doesn't matter how much of your production's here, any UK VFX spend will get that rate. So it's another way that the UK government is supporting the creative industries over here. Already this year, we've had an announcement of £60 million worth of investment into UK creative sector companies to try and drive growth in the industry. And there's a business rates relief. So tax on your buildings, essentially in your office space in the UK, there's 40% relief that's going to be available for studios. Again, another reason that the UK creative sector is doing so well at the moment. We've got huge growth in studios, and the government really is supporting the sector.
That's great to hear. And I know when we last met on this master series, Lloyd, we were discussing the newly introduced independent film tax credit. Can you kind of walk us through what has the response been to the independent film tax credit as it relates to kind of, what's going on with AVEC as well as...
Yeah. Absolutely. So it's a strand of AVEC. That's the first thing to say, is that it's not different. It's part of the AVEC regime. It's an enhanced rate for sub £23.5 million films. And the response has been unanimously good, really. We're having constant conversations with UK independents who are going, well, basically, I've got 10% less of my budget that I've got to find now, which is fantastic. But also a lot of conversations with American producers going, oh, am I able to access this? And the short answer is, so long as you meet the criteria, so you pass the cultural test and you've got a UK writer or director, yes, absolutely. There's nothing to stop you. So we're having a lot of conversations at the moment. I know I've been having conversations with your clients and all sorts of EP clients of, this isn't limited to UK production companies. This is available to anyone who wants to come to the UK and film. So let us help you access it and monetize it and really gain value from it. It's been a huge shot in the arm for the independent film sector. I've not seen the sort of excitement be as high for UK indie film in quite a while.
It's exciting to hear.
Yeah.
I mean, it's great news for all of us too. Just we want to make sure we're supporting not just the big studios, but the independents as well. So it's great. And for those shooting in the UK in 2025, there are some key changes coming, which will need to be factored into your production budgets. So I think with that, we're going to kind of move over to Kristy and ask her some questions specifically for our North American clients in the audience. It is important to understand some of the key differences between the UK tax system and the US system. We get a lot of questions around that, especially as Lloyd said, when we have US productions looking to go and try and maximize the IFTC, there is a lot of questions on how to make sure they do that. And then what is the overall impact on their budget? So maybe what we can do, Kristy, is let's start with some of the basics and just some important distinctions for productions filming in the UK. Who is considered the employer and who is responsible for tax liabilities to the UK government? So again, just some of the basics here for our folks on.
Sure. You're right. This is a question we get asked an awful lot. So in the US, your payroll service provider, so in this example, Entertainment Partners is the employer of record. So technically the employer and therefore responsible for the tax liabilities for the calculation and for the payment of those tax liabilities to the revenue. In the UK, however, it is slightly different. The production company itself, so the legal entity here in the UK, is the employer. And your payroll service provider, again, Entertainment Partners in this example, is purely a service provider. We're just there facilitating your payroll for you. We aren't liable for any of the employment taxes. The production company is the people responsible for determining the employment tax status of the crew, and also are responsible for ensuring those tax liabilities are paid across to the revenue. So what I mean by the tax status determination of the crew is that we have employed workers. So they are your employees who go through the UK tax system, so known as PAYE over here, so pay as you earn. So they are taxed at source and they have their national insurance contributions taken at source, and that is all processed through payroll and therefore remitted to the revenue on a weekly basis as they're paid. So that responsibility is with the employer. They also fall into the UK pensions auto-enrolment legislation where they're eligible to be in a pension scheme, and the employer has to contribute to that on their behalf. We do have a little quirk here in the UK. So the government, the HMRC, has this dispensation which allows certain job roles within our industry only to be treated or to behave like self-employed workers. And that's referred to as the Appendix 1. So Appendix 1 self-employed workers, they are responsible for reporting their own taxes. They are responsible for paying their own taxes. So that is not responsibility of the production company. However, again, we like a little nuance. They also fall into the UK pensions auto-enrolment legislation. So they are entitled to be part of a workplace pension scheme. Although they are behaving as self-employed, they are a worker. So they are entitled to be part of that pension scheme, and the production company would also have to contribute towards that. So in a nutshell, the production company is responsible. They are the employer. They are the one that is responsible for paying over all of the income taxes, national insurance and pension contributions. But 9 times out of 10, production companies are going to use a payroll service provider like entertainment partners who are going to manage that for you, take the burden, make sure that's all remitted, make sure it's paid over accurately and on time. So that's the main distinction between the two territories. I think it's quite confusing. Sometimes there's an expectation that we are the employer of record here in the UK, but it is actually the production company themselves.
Yeah, and we discussed this, I think, in our last master series when we had our guest Aaron Williams on, and we were discussing the importance of making sure when you're thinking about going to the UK, making sure you have ironed out your company structure prior to coming, just to make sure you know who is going to be responsible for that employer role. And so I think that is definitely a unique nuance. I know that we were talking a little bit about employer versus hirer, employee versus self-employed. And I know that we were talking a little bit about the tax situation as well as the national insurance. And I think when, again, we had some of our UK team out at the end of the year talking with some of our clients here in the US, this was kind of a big hot button, just kind of making sure everyone was really clear around the nuance around national insurance and the employer contributions. So national insurance, you'll also hear it called NICs, and really how that program works and operates and what the impact is to that on a production budget. So maybe, Kristy, if you can just kind of walk us through some of that. I think it would just, again, this is basics, guys. We're just trying to help you guys understand the nuance. But if Kristy, you could walk us through it, I think that'd be great.
Sure. To keep it simple, because it is quite a complex little system of, I suppose, the best way to describe it, national insurance is akin to your social security in the US. National insurance entitles the payee to state benefits, so they can get access to healthcare, they can get a state pension, hopefully. And also they're entitled to unemployment benefits as well. So it's similar to your social security in a sense. It's also an employee and employer contributed scheme. With employers' national insurance, if I am contracted for £1,000 a week, you as an employer are going to be paying employers' national insurance on top of that £1,000 a week. So when it comes to your budget, you have to always ensure that you are accruing for the fact that you're going to be paying that additional percentage on top of the gross salary that you've agreed. So it's an on-cost, it's a fringe. So that on-cost needs to be recorded in your budget to ensure that, you're not overspending.
Move Your Magic has got all the tools you need to be able to do that as well, and tag it up and apply the fringes throughout.
Yeah.
And then maybe, Kristy, just a little bit around the roles, the HMRC managed roles. Did you mention those that are some of the nuances?
Appendix 1, yes. So that's the self-employed people. So those Appendix 1 self-employed people, they don't attract national insurance contributions. So they are a group of people which don't fall into the national insurance bracket because they are claiming to be self-employed. So it's only PAYE people, so only those true employees that go through the tax system in the UK.
Awesome. Thank you for the clarification. Now, I know there are some changes coming to this. I think there are two specific changes going into effect in April. Maybe if you can kind of walk us through what are those changes coming in April, and what that impact is on those changes.
So we do have some changes. In the budget, they kindly announced they were putting up the rate of employers' national insurance. So in the current tax year, it is 13.8% is the rate that we're currently paying for employers' national insurance. From the 6th of April in the new tax year, it's going up to 15%, which at first doesn't seem too drastic. They then bold in with an additional change of changing the threshold. So that's what I'm saying. National insurance, it's slightly more complicated than just a pure percentage. There are thresholds of which you start to pay those contributions as an employee and an employer. But the employer's threshold has been reduced for the new tax year. So currently it's £9,100 per annum before you start contributing. It's been reduced to £5,000 per annum. So looking at it on a weekly pay basis, in the current tax year, you as an employer don't start paying any employer's national insurance until after that person has earned over £175. But in the new tax year, you're going to start paying it when they start earning over £96. So not only has the percentage gone up, the point at which you start contributing the employer's national insurance is also going to start earlier within their payroll. So it's quite a substantial increase. So it's a bit of a challenge, I think, in terms of budgeting. It's definitely gonna cause some quite large increases.
And then, Kristy, can you help us understand the impact on a larger production versus a smaller independent production? Is it impacted the same way? Is there nuance there that folks need to consider?
So every employer, every production is going to be affected in the same ways. Those rates apply to all. I suppose larger production, larger budget, larger on costs. It will soon start to ramp up in terms of your on costs. The one thing is there is a mild consolation. There has been a change to the legislation. So we have what is called an employment allowance, which is that it gives you almost part of your employer's national insurance back in a tax year. That in this current tax year has an eligibility criteria. So your employer's national insurance total bill for the year has to be less than £100,000 to be eligible to get that allowance in this current tax year. Well, from the new tax year, from the 6th of April, that threshold's being removed. So every employer is now entitled to have this employment allowance. That does actually benefit larger productions now, where they would previously not have been eligible to get this employment allowance. Also, they have kindly increased the rate. So this year it's £5,000 allowance, and from the new tax year, 6th of April, it'll be £10,500. So that helps a little towards what's coming. So we looked at it from an average pay perspective. So we were looking at, I looked at £100 million feature film and went, okay, the average weekly pay is X amount. Looked at a TV show that's 50 million and also got the average pay. And it was roughly about the same across the two productions. So it was about £1,600 a week in terms of the average pay. So looking at the national insurance that we have for this tax year versus next tax year, the increase of employers' national insurance on that average pay is nearly £29, and that's per week. So if you were looking at a feature film and you had 100 PAYE crew over an 8-week shoot, you're talking an additional cost in the next tax year of about £23,000. You can see all the numbers on the slide. I won't quote them verbatim, but take then circling back to that employment allowance I just spoke about. Well, that does help a little bit. That does reduce it down. You're still paying more, but it's at least taking a little bit of that away. And then Lloyd has kindly put in the incentive value there too, that could also potentially could be claimed back. So we're kind of just trying to show on this slide the net impact to a production of what the budget needs to increase by for the next tax year, to take all of that into account and make sure that it's all being thought about in advance.
Yeah, I suppose the point for me to chime in here just a little bit in terms of the value of the incentive. All assuming your staff are working in the UK, they're going to be eligible for incentive. So there's no distinction between Appendix 1, Schedule 1, self-employed, employed, or anything like that. If they're indeed, from a UK incentive perspective, we don't even care if they're UK people. Tom Cruise is eligible if he's working over here. So there is at least the sort of a net impact that any increase is going to be eligible for the incentive. So as Kristy says, we've put on there just a basic, if you were a completely UK production, the net increase would be reduced by this amount. So there is that as well, which helps to soften the impact slightly. I get to be the bearer of good news on this bit.
Thank you. I'll be the bad news. You can be the good.
No, I do think the visual is very helpful. So thank you, Kristy and Lloyd, for putting that together for the audience so that they can kind of visualize what the impact of this change is and what that means for a production. So I think it's helpful. I think, Kristy, I'm not sure if we mentioned the secondary threshold. Is that also, do we want to discuss that a little bit with the application of that as it relates to this?
So the secondary threshold is the threshold that has been kindly reduced as well for the employer's national insurance. There is a small population where anybody under the age of 21 or apprentices under the age of 25, that threshold is massively increased. So if you are employing people that are younger or apprentices, there is a benefit in terms of national insurance, because the threshold of which you're going to start contributing national insurance isn't until that person is earning over £966 a week. So it's quite beneficial in a sense. So there is they're giving and they're taking. We've got a happy balance going on here. So it's if you have those younger people working on production, there is a slight benefit in terms of the on costs.
Yeah, thanks for calling that out. And again, I think this is just more information around just the nuance that we're seeing in some of the changes. So, it's just important to make sure we're articulating it all for everyone on the call. So just on that note, with the contribution rate and the threshold for paying those contributions both changing, what this will look like actually in practice, I think is also probably a good example we can give this group, if that makes sense.
Yeah, so that's kind of like where this slide comes in. So on the previous slide, there was the kind of breakdown per an average worker. So that's the £29 extra a week that they would be contributed by an employer in national insurance. And then this was the visual just to say, if you had 100 PAYE crew working, what does that total impact look like to your budget? It's definitely an increase. It's definitely, we can't hide it, we can't deny it. There is definitely going to be an impact to the budgets post the 6th of April in terms of crew. So it's just something to bear in mind if you are. And again, it's one of those things of, this isn't something that's grandfathered. It is from the 6th of April, all of these rates will change. So if you've employed somebody prior to the 6th of April, they are going to have their rates changed. So making sure that has been taken into account when you're doing your budget.
Perfect. And then do we also want to discuss the living wage and minimum wages also that are changing in April, yes. Correct, I believe?
Yes, because I love being the bearer of good news. So if we could go on to the next slide, please. So the national living wage, that is for anybody over the age of 21. That is increasing marginally, not massively, from in the current year. So also, just to call out, this is from the 1st of April, whereas the tax year is from the 6th of April. We like to clearly keep it, slightly consistent, but not quite consistent enough. So it's increasing from £11.44 to £12.21 per hour for anybody that's currently on the national living wage minimums. So on a production, shooting a 50-hour week from the 1st of April, if you are employing somebody that is currently on the £11.44 in the new world from the 1st of April, your costs are going to go up on the gross pay alone by £38.50. So each week you are then going to be paying slightly more towards, your budget is going to reduce slightly. And again, the national insurance will obviously increase as well come the 6th of April. National minimum wage is for people younger than 21. So we've got the bracket, which this is the biggest increase, which is the ages of 18 to 20. So that's going from the £8.60 to the £10 an hour, which is one of the biggest increases we've seen for quite a few years. So that, again, on a production that 18-year-old is working 50 hours that week, that's actually £70 extra for the production per week. And as I said, again, that's without any on costs, that's without your national insurance, and that's without your pension contributions on top. So there is a bit of an increase that needs to be considered when budgeting. We've then got the next bracket, which is the even younger. We've got the 16 to 18-year-olds and the apprentices. So £6.40 going to £7.55. pushing apprentices to one side for a second, the 16 to 18-year-olds, they are deemed as young workers, so they can't work 50 hours a week. So they can only work 40 hours a week. So in that sense, they would be an additional cost of like £46 a week, again, without the on-costs. But the on-costs are slightly different because they fall into that under 21 bracket for national insurance. So like I say, it's just a balancing act the whole way along. I think it's one thing to think about that as part of your budget, but it's really, really important to think about this from a compliance standpoint as well. When you're contracting your crew, making sure that you are contracting them at a rate that is equal to or above these minimums. There are some hefty penalties if you are seen to not be paying people at these levels. So, I mean, that really would hit your budget.
The government actually name and shame now, don't
they?
Do. They publish a list now of companies that do not meet the minimum wage threshold. So it's not a list anyone wants to get on.
No, it's definitely not the list you want to be on. So just from a perspective, from a payroll service perspective, so entertainment partners, we do have a payroll system that flags if you're paying somebody that is falling beneath these minimums. And then, of course, that gets reported back to production straight away to ensure that, that's rectified as soon as possible. So, just to keep that in mind, not just from a budgetary perspective, but from a compliance perspective.
And then chipping in from my side, if you're the bearer of bad news and Lloyd is good news, I'm slightly uncertain, contrary news. But working with kind of big groups or kind of pockets of these self-employed workers, which is kind of what I interact with a lot in the UK, there are kind of different subsets of the UK rates agreements, whether that's talent agreements. So in my example, kind of supporting artists, background talent, who skirt around this national minimum wage rate. Now, as a good example of why you should really kind of watch this, and EP will do a brilliant job from a payroll perspective in terms of flagging it. But you can have pockets of people like supporting artists who run on these rates agreements. So, for example, there are 2 in the UK, they updated in January. They occasionally have rules which will say if your production was already budgeted, you can wait until you're done, and the next show you go on to, you can use the new rates agreement. You should check that, because if your show is running, let's say, for example, from February to October, and you're like, oh, that's fine, I'm going to use the 2024 talent agreement, the national minimum wage could go up, and the amount that you're actually paying, let's say 500 supporting artists on a big crowd date, could actually be below the national minimum wage, national living wage. So it's just an area to watch. If you think you've got it covered in terms of PAYE and all kind of the people who are more permanently working for you, be mindful that you could have big groups of pockets, freelancers, contractors, etc., who could potentially sting you when it comes to this particular change.
It's a good call out, Katie. Thank you. And again, for our users who have joined, I think it's just important, if you have questions about this afterwards, obviously this group of individuals is happy to help you understand if you may be in that area. So with that being said, I think we'd love to kind of go into, and maybe this is really back to you, Lloyd, just with all the changes that Kristy and Katie have kind of talked about, what is the impact on incentives? I know we had like a little bit of an example, but I think it'd be great just to kind of talk a little bit about, any good news for the clients as it relates to the impact on where they can pick it up and save.
No problem. I saw this one of the points that was raised in the Q&A as well. Yes, national insurance contributions are an eligible fringe. They are part of your production costs. So assuming that person is working in the UK, you will get tax credit on the increase. So you will, whatever regime you're under, in the example on the slide, we use 20.4% being the standard rate. If you were doing an IFTC eligible production that was all UK, you'd be getting incentive of 31.8% on the national insurance contribution. So it does have a way of mitigating the overall cost to you. It's always on a used and consumed basis, so the person has to be working in the UK. If you're employing someone in the UK who is working overseas, you aren't going to get incentive on them. So therefore, you would bear the cost of this. So say you had a UK DOP that was working in Hungary, for instance. Yes, their national insurance contributions would go up. Well, probably a bad example because they're going to be in Schedule 1, but hypothetically, their national insurance contribution costs would go up, but you wouldn't get incentive because on a used consume basis, they're not UK. So any UK-based employees would do that. Practically, it's going to come later in the day. You're still going to have to pay it out at the gross level, but the incentive you receive at the end of production is going to go up. And just to add on to one thing that Kristy mentioned earlier about making sure you consider it for ongoing productions would, from me, from an incentive and sort of budgeting perspective, would be to say, make sure you revise your forecasts, your ETCs within your cost report, and that you don't just get stung with an unexpected overage. This is coming. That, as Katie said, there's no grandfathering in, so you've got to deal with this from 1 April. But there may be a minor uplift to your incentive, so at least there's that kind of in offsetting.
Great, thanks, Lloyd. And I think we've talked a lot about changes that are coming and that are confirmed, and so to go into effect starting in April, but there are some additional changes, I think, if I'm not mistaken, Katie, right, that are coming to UK employment law that are being discussed that I think we want to kind of bring up here just to, again, create some awareness of what is happening and what those proposed changes are and what the impact of that would be. So maybe you could kind of walk us through what's also being discussed in addition to what we know is coming.
Yes, exactly. So, like I said, if Lloyd and Kristy are the bearers of very certain confirmed news, there is a swathe of things potentially coming that are all kind of interlinked, but it's to do with something called the Employment Rights Bill. So that is a bill that was published in October by our new Labour government. It was a bill that they ran on very strongly, which means they feel very strongly about it, which means there is likely to be something out of the list of things that I talk about that comes into play in the next 12 to 18 months. And it's kind of split into various categories, but there are a number of things that become quite significant when you are working in the UK. So if you go back to Kristy's definition of the fact that you have PAYE employees, so people on the payroll, pay as you earn, and then let's keep it as the broad category of people who are self-employed. There are a number of things that become very instrumental to PAYE employees. So the first is fire and rehire. So this is something in the bill published in October that has gone to the Commons. So in discussion, but likely to come in 2026. It's automatically unfair to dismiss an employee if they refuse any type of variation of their contract. Now, with all of these things, the way the film industry works, the way production works, means it becomes quite hard to wiggle some of this into the way in which production spins up, spins down. So fire and rehire is definitely one to be mindful of. You cannot let someone go, change their contract terms and bring them back on again. There is something similar around 0 hours contracts. So these are contracts where a worker doesn't necessarily have guaranteed hours. You kind of keep them on contract and then you can bring them in ad hoc to do work. The opinion of the government is that they are exploitative contracts and they want to get rid of something called one-sided flexibility, where the ultimate power is with the hire employer. So 0 hours contracts are on the way out. And a contract with guaranteed hours. And also there's like a subpart to it, which is around reasonable notice, around shifts changing. That is like a big legislative point that's kind of being lumped into that group as well. Again, how this fits with the production industry, the whole thing is in consultation over the next couple of months. There are lots of different UK unions and kind of creative industries that are speaking about it, but it will make it harder to kind of work with people in certain flexible ways. The other kind of big group is something called day one employment rights. So that's includes things like unfair dismissal, sick leave, paternity and maternity and kind of parental pay, and flexible working. So day one employment rights basically does what it says on the tin. From the first day you were employed as a PAYE employee at that company, you're entitled to certain things. So in the UK currently, there's a 2-year qualifying period. And during the 2 years, you can be dismissed kind of regardless of a probationary period. That is on the way out. So you can kind of get the gist here. This is all kind of power to the workers. I think the slogan for this is make work pay. This is kind of trying to balance the power between the hirer and the employee. Day one sick leave, again, that means that from the very first day you work, you are entitled to statutory sick pay. So all of the things that Kristy's been outlining here in terms of what hits the budget, sick leave, when the reform comes in, TBC when, that again is one to watch in terms of the budget. There was also kind of a 3-day waiting period where you would have to get some level of confirmation from around what was going on with the worker before the statutory kicked in. The proposition is that kind of ducks out as well. So from day one, you're entitled to these benefits. And it's the same with paternity, maternity, parental leave. Again, day one employment rights. So from your first day of work, you are entitled to the statutory. So with all these things, it's kind of worth thinking about and looking into the future a bit more around, actually, do you have people hired in the right categories? Do your contracts make sense in the long term with all of these different benefits that could hit certain different employee categories? The only other big one, which is already in play, which is probably going to get some tightening up, is in terms of day one rights, is flexible working. So from the first day you work, you can request flexible working. As it currently stands, the employer can write something back and say, for XYZ reason, we don't think this is feasible, or they can agree and you work out a structure. The government are going to tighten that up. So the reasoning, if you do decline someone's flexible working request, they can request twice within a year, I think, under the new proposed legislation. The written reason has to be robust. There's like a number of criteria that you have to hit to turn that down. So again, until these things are properly enshrined, kind of come out of the Commons, you don't really need to do anything, but it is worth looking at working policies, the arrangements that you have with different pockets of employees and different employee types that you have in the UK, and working out how feasible they could be in the long term with all of these proposed changes coming.
Yeah, I think that's right. I think it's really about the planning for your budget and just making sure that, if you're on a tight budget and one of these changes were to go into effect, what would the impact be? Just to make sure that you're thinking through kind of any of the impact of these changes. I think the other question we have, Katie, if you can maybe go through it a little bit, is just the single worker status. And that being, I think, another area that we've had clients ask about and looking to watch.
Yes. This is somewhat of a complicated one, so stay with me. I'm going to go back to kind of some of Kristy's definitions around worker statuses. So your PAYE, your full-blown employee, paid on the payroll, taxed at source, etc. That is a well-established definition. You then have self-employed / freelancer in the UK. That is very complicated. We've been through things like IR35 in the UK, what a freelancer is, how that's determined is extremely complex. The Labour government are proposing that we move to a single worker status, and that is kind of driven by the idea that there are some people who are classed as self-employed. So in some of the examples that Kristy gave, you are self-employed for tax and national insurance purposes, but you are still guided to do certain things on set. You cannot decide what time you show up. You don't necessarily provide your own equipment, but you kind of fall into this self-employed category. The initiative around this is to basically end false self-employment. And by that, we mean that an employer is not doing things like paying national insurance, paying into your pension, that you don't get company benefits, that you don't get day one workers' rights that we just discussed, so that you're not shirking a bunch of responsibility for a group of people who should be employed. However, this is very complex. So it's why the Labour government have almost put this in a list in their employment bill, which is stuff we're going to investigate later because it requires a lot of consultation. But it is like a massive one to watch because such a significant amount of the creative industries, the film and TV industry, are made up of freelancers. So if you're familiar with the UK union bodies, kind of creative groups, whether it's kind of PAX, the Producers Union, or BETU, they have all had very strong opinions on single worker status. The reason being is that, using the example of the group that I work with quite prominently, supporting artists, you can go on multiple different engagements with multiple different hirers. Yeah, outside of tax and national insurance world, you're not really self-employed when you look at kind of some of the IR35 type definitions. However, if you were to make each one of these people full-blown employees in a single worker tax status world, that is also very complex. We went through a similar thing when it came to auto-enrollment legislation in the UK. It's a blanket reform, but it doesn't really work that well with the gig economy. So this is why Labour have put this onto the list of stuff we do later. The reason why we should watch it is something they massively ran on in the election. It is something that the UK unions have been very vocal about wanting to have a consultation on and for Labour to deliver on. If it changes, like, in the most basic sense of how it hits the budget and the payroll, on one production, you could have 60% of your employees are freelancers. The next time you go and do a production, that amount could be considerably less. You could have way more people who are PAYE, which obviously overall, as we've discussed in relation to the other changes, makes production very expensive. We don't know when this is going to happen. So kind of saying, I'm forecasting potential news, but understanding who is self-employed, who is not, and this kind of nuance between self-employed worker and watching that is definitely something I would recommend.
Yeah, thank you. I think it's an important just concept to understand of, kind of what's happening on the ground, so that as people are thinking about going to the UK, they've got all of the information possible. So hopefully we'll do a little recap here, but hopefully this is really helpful for everybody just to kind of understand what is happening, what is confirmed, what is coming, and then just some of the kind of nuanced potential changes that we're looking at and just trying to keep you all informed upon. So just as a quick recap, we've talked about the employer of record and how it's treated differently in the US versus the UK, how it's important to know the distinction on your associated tax liabilities, making sure your companies are set up correctly. We also discussed the increase in employer NIC, so that's the national insurance, and how that will lead to an increase in payroll costs for most employers. So just make sure you speak to your payroll provider, hopefully EP, and be sure to factor these changes into your budget. And again, just making sure that those changes go in with the appropriate date. I know we talked about April 1st versus April 6th. So this was the one that's April 6th. Correct me if I'm wrong on that. And it will apply to existing productions from that date. So again, just making sure that if you have a production currently or thinking about going or actively in the UK, just make sure that you've got that change planned. We've also talked about the increase in the national wage minimums. That is the date of April 1st. So those are the minimum wages that Kristy went through. And again, your payroll provider will action these, in their system. We will obviously have those minimums, as Kristy mentioned, it coded in our payroll system so that those changes are in effect. So you shouldn't have to worry about it, and it will flag it. But you may see an increase in those costs. And then again, Lloyd, thank you for being on this call as our incentive expert. But again, speak to your incentives provider, again, hopefully EP. If you have questions about any of the qualifications of that spend and the impact of that qualification to the value of your incentive, I think is important. Again, while there are increases, it does create uplift, as Lloyd had mentioned earlier. And then we will keep you up to date to all the other potential changes, as Katie discussed. Again, we're just trying to keep you guys informed as we are hearing information. We want to make sure we're sharing it with you. So again, we will keep you up to date. And I think we have a few minutes if we want to, Natalie, I think, look at some of the questions that we can, give to the group and answer.
Yeah, we can address just a couple of questions. Thank you to everyone who submitted questions, and we did address some of these in the conversation, but just going to pull a few. So this is going to be for Kristy. So going back to the national employer contribution increases, is everything happening automatically? Does the production need to take any proactive action, or is it just staying on top of knowing when those dates are and how the changes will impact your budget going forward? I remember penalties
Yeah.
somewhere.
No, it will happen automatically. So most payroll systems in the UK will have our end of tax year process where we send all the documentation to the employees, and then there'll be a start of year process where all of those rates and thresholds are increased automatically. So the first payroll run of the tax year, all of your rates and thresholds will be in place automatically. Good for the production to keep note that they're expecting an increase, so that obviously when they receive their reports, they're not shocked by the fact that the figures have maybe gone up slightly since the week before. But no, absolutely nothing they need to do, all managed by your payroll service provider, like Caitlin says, hopefully EP.
Yes, hopefully EP. All right. We got a question about the incentives. So Lloyd, you walked us through the wonderful breakdown, and we got a question. So going to the UK for the first time, how do we even apply for that tax credit? What are the process that we need to go through?
Twofold. You need to qualify as a company and you need to qualify as a production. So the UK's got certain criteria for how you qualify as a company. You do need to have a UK company, but that's really easy to set up comparatively, something we can assist you with. And then you need to make sure that your production is going to qualify. We have what's called the cultural test that all productions need to pass in order to get the UK incentive. And we're actually going to run a master series on that in the next couple of months to run through that in detail. We're going to get someone from the BFI who administer that test along to help talk about how best to approach it. They're the two key things up front. There's a lot more to it, but they're the main things. The one key thing is you can't retrofit the UK tax credit. You can't change and get it after the fact. You've got to do certain things in advance. So please come and speak to us early if you're looking at it, and we can help you figuring out how you qualify the best way for that and what it's going to be worth for you.
All right, wonderful. I see a few more payroll related questions. So Kristy, I'm going to jump back to you just for a minute. We mentioned that, all these changes are going into effect automatically. When it comes to any sort of penalties or any figures that people should watch out for, is there any sort of grace period, or can you speak any more about what penalties are there? Anything that the productions should be watching out for?
So in relation to the employer's national insurance piece, no, you need to be compliant. But as I said in the previous question, your payroll system will be compliant. So there aren't any penalties. And if you were deemed to be calculating beneath the current percentage rates or thresholds, the HMRC would contact you and ask you to rectify it. There would be a certain amount of grace period. They would probably want to understand why you weren't doing it correctly. But there are no rates or penalties in relation to the employer's national insurance piece. Like I said, the only thing to watch out for is those minimum wages. That's the one where there are really strong penalties for not paying people at the correct minimum wage rate.
Okay. On the topic of the minimum wage, we did get a question about if holiday pay is included in that minimum wage conversation. Is anything changing there, or is that included?
No. That minimum wage is the amount you should be paid. That is the minimum that you should be receiving in your pay each week. Okay. The holiday pool would have to go on top of that.
Okay, wonderful. Thank you. While we're talking about all of these changes that are coming and keeping an eye on budgets and April 1st versus April 6th and anything else coming down the line, Caitlin, do you have any tips for our U.S. productions about keeping an eye on their budget while they're filming, while things are active, or just how to best practice for how to prevent any mishaps in your budget?
Yeah, I think, part of the reason for this master series is to make sure that people do have the correct figures in their budget. I think the biggest change that we've seen is that with the national insurance, we had a lot of clients who were budgeting for the increase. What they didn't realize is the threshold change, right? So I think that's probably the most important piece to kind of capture, is that it's not just the increase in the national insurance. It's the fact that the threshold is going from, someone's going to have to keep me honest here, 9.1 to 5,000 pounds, right? So they're lowering the threshold, which essentially opens up the population and increases the number of people that are now included in that cost. So it's just making sure that you guys are including that piece of that change, I think is probably one of the ones to watch out for, as well as Kristy and Lloyd and Katie talked about the minimum wage. I don't think anyone wants to be on the nasty list. Making sure, I think that's what you said, right, Lloyd? Making sure that you've got that timing in your budget of when that change is going to go into effect and what that impact looks like. So, making sure your globals are up to date and factor in that change, I think is really the two areas to watch out for. And then, as Katie said, we'll keep you guys informed as the changes unfold in the UK and what actually comes down as it relates to the self-employed versus PAYE.
All right, wonderful. Well, we are actually at the end of our time. So thank you, panelists, for everything that you have taken us through today. And thank you to our audience for sticking with us through this wonderful conversation. I do want to advise that if there were any questions that we didn't have time for today, we encourage you to head over to the production lot. It is our new community site, and you can post questions for our experts there. Katie, Lloyd, Kristy, Caitlin, and all of the experts at Entertainment Partners can head over and see the questions that you're asking, and we can address questions for you there. It's also a great way for you to meet other people from the networks, to build out your network, to ask questions, to access information. It's a wonderful resource, and we really encourage you to check it out. So an easy way to do so is to just scan that QR code that's on the screen right now and head over. And we really look forward to seeing you on the production lot. If you would like to revisit today's webinar, and I did see a question come in about a recap and resources, you can catch all of the episodes that we have done, including today's webinar, on ep.com/masterseries. We have done, over 100 webinars at this point, and you can check out the entire library. So we encourage you to do so. So please visit us at ep.com/masterseries. And we also want to advise that we discussed a lot of big topics with a lot of details. Our wonderful experts like Katie and Lloyd and others are putting out articles weekly covering important changes in entertainment and production news, expert advice, and timely analysis of these changes that may be coming, including legislation changes, payroll changes, and anything related to incentives. So we encourage you to visit ep.com/blog to catch up with all of the thought leadership that is coming from our wonderful EP experts, and make sure that you're signed up for notifications so you never miss any of that in your inbox. So thank you, everyone, for our panelists for their time today and for all of the wonderful information that they shared, and to you, our audience, for tuning in. We look forward to seeing you again at our next Master Series.